If you really want to understand how massive global industries actually survive without, drowning in Wall Street jargon, I want you to imagine
Oh,
this.
this is a great analogy. Yeah.
Right. So you are running a business where the product you rely on to keep the lights on today is physically disappearing every single time you make a sale.
Literally vanishing from your inventory.
Exactly. And to survive, you have to start building a new product today, right now, that you won't even be able to sell until maybe 2036.
Yeah, the standard rules of business like input equals immediate output. They just completely break down here.
They really do.
It requires an entirely different mental model for risk and reward. You
Yeah.
basically have to feed the present without starving the future.
Right.
It's this massive high-stakes temporal balancing act that most people, they never get to see from the inside.
And that is exactly what we are decoding today for you. As
Yeah.
someone who loves unpacking complex mechanics without getting bogged down in all the corporate speak, you are going to appreciate this deep dive.
Oh, absolutely.
We have a huge stack of sources detailing the Q1 2026 earnings presentation from Murphy Oil Corporation, which was led by their CEO, Eric M. Hambley, on May 7th, 2026.
And our mission today isn't just to read a balance sheet to you. I mean, nobody wants that.
Definitely not.
We are looking under the hood of a corporate survival strategy. How does an independent energy producer balance the intense immediate demand from investors for cash payouts today with the absolute physical necessity to hunt for oil that literally won't reach the market until the next decade?
Okay, let's unpack this, because to understand where Murphy Oil is heading, we first have to look at the ground they are standing on in the first quarter of 2026.
Right, the baseline.
And the sheer scale of the numbers here is just striking. They are currently pulling 174,000 barrels of oil equivalent out of the ground every single day.
Every day. It's wild.
And sitting beneath the earth, they have 715 million barrels in proven reserves.
Yeah, and, those reserves act as the physical bank account of an exploration and production company.
Their safety net, basically.
Exactly, it's what gives them a future. But their financial bank account is just as robust right now. Like, in this single quarter, they reported $466 million in adjusted EBITDAX.
Wow.
Yeah, and $41 million in free cash flow, all while keeping their net debt incredibly low at $1.172 billion.
Wait, let me stop you right there, because adjusted EBITDAX, that is exactly the kind of Wall Street jargon we promised to cut through.
Fair point. Fair point.
I mean, earnings before interest, taxes, depreciation, amortization, and exploration. It's a massive mouthful. What does that actually mean for the health of the company?
So think of adjusted EBITDAX as the raw, unfiltered cash generated by the physical act of pulling oil out of the ground and selling it.
Okay.
Like, this is before the accountants and the tax man get their hands on it, and before you factor in the money spent hunting for new oil.
Oh, I see.
It is the purest measure of whether their core daily operation is actually profitable. And at $466 million in just one quarter, the answer is a resounding yes.
Which means they are keeping a remarkably tight ship in what is, a notoriously capital-intensive industry.
Oh, absolutely.
And looking at the data, they are heavily prioritizing the shareholder with all that cash.
Yeah, big time.
Since 2013, they have returned $4.5 billion to shareholders. In Q1 alone, they bumped up their annualized dividend to $1.40 per share, returning $50 million directly to investors.
All while actively maintaining a $550 million share repurchase program, too.
Right. Why the heavy focus on giving it all back so fast?
Well, if we connect this to the bigger picture, energy companies are under immense systemic pressure from the market to show financial discipline today.
Because of what happened in the past.
Exactly. Investors lived through the wild boom and bust cycles of the 2010s, right? Where companies chased growth at any cost, and they just got burned.
Yeah, the shale boom hangover.
Right. Now, the market demands its returns immediately. But as we established, Murphy is dealing with a depleting physical resource.
Every barrel sold today is gone forever.
Bingo. So they operate on this strict framework, allocating a minimum of 50% of their adjusted free cash flow straight back to the shareholders, and then dedicating up to 50% to strengthening the balance sheet.
I look at this framework and it really reminds me of managing a personal investment portfolio using a barbell strategy.
Oh, that's a good way to frame it.
Yeah, I want you to imagine managing your own household budget this way. On one end of the barbell, you have your safe, reliable day job. It pays the bills predictably every 2 weeks.
Right.
For Murphy, that is their North American onshore shale operations. On the other end of the barbell, you have this high-risk, high-reward venture capital bet.
High-stakes stuff.
Right. So you're funneling a portion of your paycheck into a locked-up startup investment, hoping to build a massive dream house 10 years down the line.
And the key there is that the safe end of the barbell completely funds the high-risk end. And it requires incredible discipline so the barbell doesn't, tip over. You are paying out dividends, putting food on your table today, while aggressively funding a very uncertain future.
Which means that safe end of the barbell has to be absolutely bulletproof.
It has to be.
If the multi-billion-dollar offshore projects are the venture capital bets, the onshore operations have to be a reliable cash engine that never stalls. So let's look at how Murphy is keeping that engine running in the Eagle Ford Shale down in Texas.
Right. The Eagle Ford is basically their operational bedrock. In the first quarter of 2026, they brought 15 operated wells online there.
Okay.
But the compelling narrative here is really found in their efficiency metrics. Since 2023, Murphy has increased the horizontal lateral length of their drilling by an incredible 47%.
Okay, wait, I have to play devil's advocate here because the physics of this just seem contradictory.
Oh, really? How so?
Well, the sources say they increased the horizontal drilling length by 47%, but at the exact same time, they reduced the drilling cost per completed lateral foot by 29%.
Yeah, that's right.
But wait, how is it physically possible to drill almost 50% further horizontally into solid rock, but make it nearly 30% cheaper per foot? Are they just, putting thinner, cheaper pipe in the ground to save a buck?
I know, right? It totally looks like a paradox on paper, but it's actually a masterclass in economies of scale and manufacturing precision.
So no cheap pipes.
No, it's not about cutting corners at all. It really just comes down to the mechanics of fixed versus marginal costs in the oil field.
Break that down for us. What does the actual physical process look like?
Sure. So think about what it takes to start a well. You have to lease a massive drilling rig.
Right.
You have to physically truck that towering structure to a remote site, literally piece by piece. You pave a pad, secure the water supply, house a specialized crew, and mix all the initial drilling fluids.
Sounds expensive.
Oh, it is. Those are massive multi-million-dollar fixed upfront costs before you even pull a single drop of oil out of the ground.
So if you drill a short well, those massive setup costs are just divided by a really small number of feet. Every single foot carries a huge financial burden.
You nailed it. Exactly. But the marginal cost, like the actual price of just keeping the drill bit turning for one more hour once it's already 2 miles deep, is relatively low.
Oh, I see.
So if you have the engineering prowess to turn that bit horizontally and keep it chewing through rock for 3 miles instead of 2, you are diluting all those heavy surface mobilization costs across thousands of additional feet of oil-soaked rock.
Oh.
That is the physical mechanism behind a 47% longer well that is somehow 29% cheaper per foot.
So the longer the pipe, the cheaper the foot, because you've already paid the massive entry fee at the surface.
Exactly.
That is fascinating. And the data shows this efficiency factory is really paying off. In their Catarina program, they are seeing a 27% increase in 60-day cumulative oil production compared to the exact same type of wells they drilled just a year prior in 2025.
It's impressive.
They are literally forcing the rock to give up more resource for way less money.
Yeah, and they have a massive runway to keep doing it, too. They have 50 years of onshore inventory mapped out.
50 years.
50 years, with a breaking price of under $57 a barrel. As long as the global price of oil remains above that $57 floor, that Eagle Ford engine will just continually print free cash flow.
Okay, so the Eagle Ford is a highly tuned machine. But a company this size can't just stuff that cash under a mattress. Where are they deploying it to secure their future?
Right.
The answer takes us pretty far away from the Texas dirt. Here's where it gets really interesting. The massive capital expenditure is going into the deep water.
Yeah.
Specifically the Gulf of America and halfway across the world in Vietnam.
Right, and we can see this shift clearly in their 2026 capital plan. It's set at $1.2 to $1.3 billion.
That's a huge budget.
It is. But the defining characteristic of this budget is that 70% of that capital is heavily front-loaded into the first half of the year.
Why the massive rush in the first 6 months?
Well, because offshore infrastructure doesn't operate on a smooth, continuous curve like onshore shale drilling does.
Right.
It requires massive, concentrated bursts of funding to hit specific, unforgiving project milestones. You are ordering custom-built steel structures and securing specialized marine labor literally years in advance.
Let's look at Vietnam first to illustrate this. They are progressing a project called Vang, which translates to the Golden Camel.
Yes.
In the second quarter of 2026, they are launching an FSO, a floating storage and offloading vessel. They are targeting first oil by the fourth quarter, aiming for a peak rate of 10 to 15,000 barrels a day.
And beyond just developing the Golden Camel, they had a massive exploration success at a project called Vang, or the Golden Sea Lion.
All right, I saw that.
Yeah, they were pretty well, encountered 429 feet of net oil pay, flowing at an aggregate rate of 12,000 barrels a day.
Wow.
They are now guiding the recoverable resource there toward the high end of their estimates, around 430 million barrels of oil equivalent.
Wait, I need to pause on that term, net oil pay. 429 feet of it.
Right.
So anyone outside of a geology department, that sounds like a totally random measurement. What does pay actually mean in this context?
Okay, so net oil pay is the actual vertical thickness of the rock layer that holds commercially viable oil.
Okay.
When you drill down thousands of feet, you aren't just hitting a hollow underground lake of oil, right?
Ah.
You are hitting porous rock, sort of like a hard sponge.
Right.
Pay is the portion of that rock that will actually yield oil.
Hmm.
So encountering 429 feet of net oil pay is basically like drilling straight down through a 40-story skyscraper made entirely of resource-rich rock.
Oh, wow.
It's a massive, highly concentrated find.
A 40-story building of oil.
Yeah.
That really puts the 430 million barrel estimate into perspective.
It does.
And it's not just Southeast Asia where they are hunting big game. Back closer to home in the Gulf of America, they have been aggressively expanding.
Yeah, very busy there.
They secured 14 new blocks in a recent federal lease sale. They began drilling or spudded a high-impact well called Chinook number 8. And they officially sanctioned the development of the Banjo and Cello discoveries, setting a target for first oil in late 2027.
And what's fascinating here is the sheer scale of the lead times. Like when you sanction a deepwater project like Banjo or Cello today, you are making a massive financial commitment based on a hypothesis of what the global economy and, oil demand will look like years in the future.
I try to picture the physical reality of something like the Lac da Vang FSO in Vietnam. It's basically constructing a floating skyscraper.
That's a perfect way to describe it.
You are assembling this massive, complex facility completely isolated miles from the coast in a really harsh marine environment on a strict-to-the-minute timeline.
Which brings us right back to why 70% of their capital is front-loaded. You pay for the steel, the shipyards, and the engineering completely up front.
All before you get a single drop of oil.
Exactly. The initial pain is immense, but the payoff is found in the break-even economics. Murphy has 240 million barrels of offshore resources that carry a break-even rate of less than $40 a barrel.
Wait, less than $40? We just established that the highly efficient onshore shale factory needs $57 to break even.
Yeah, and that is the beauty of the offshore model. The upfront cost to build the floating skyscraper is exorbitant, but once the pipes are hooked up, the long-term profitability per barrel is absolutely staggering.
So it prints money once it's built.
They are setting up a multi-year, highly lucrative inventory that will pay out massive dividends long after the initial construction costs are completely forgotten.
So we've seen the safe shale, the predictable cash engine, and we've seen the carefully scheduled offshore infrastructure in the Gulf and Vietnam. Those are expensive, but they are mapped out, right? The oil has been found.
Yeah, those are known quantities.
But an independent energy company can't just rest on known reserves. They have to continually hunt for the giant frontier discoveries that can change the trajectory of the entire corporation.
Exactly. And this is where we arrive at the true wildcards, the frontier exploration in West Africa.
Yes, Murphy is executing a 3-well exploration program right now in Côte d'Ivoire, and they are doing it using a specialized drill ship called the Transocean Deepwater Skyros.
An incredible piece of machinery.
This is an absolute beast of a machine. Just to rent this ship, literally just to have it float above your lease, costs $361,000 a day.
It's over $10 million a month just for the vessel. And that's before you even factor in fuel, crew, or the actual drilling materials.
Crazy.
And remember, frontier exploration means you are drilling into geology where you do not know for certain what you will find.
And they found that out the hard way, didn't they?
Unfortunately, yes.
The first 2 wells in this Côte d'Ivoire program, named Civet and Caracol, they were non-commercial. In industry terms, they were dry holes.
Yep.
They spent millions of dollars, drilled deep into the ocean floor, and found basically nothing viable. Yet, as of this earnings presentation, they haven't packed up and gone home.
They are still out there.
They are actively drilling the 3rd well in the program, called Bubble 1X. And the presentation states this prospect has an unrisked upward potential of 340 to 850 million barrels.
Right. And the term unrisked upward potential is crucial here.
What does that mean?
Unrisked means this is the absolute best case scenario. If all the geological models are perfectly correct, if the reservoir rock is as thick and porous as they hope, and if the trap holding the oil is fully sealed,
A lot of ifs.
exactly. If all that happens, it could hold up to 850 million barrels. But it does not factor in the very real probability of failure.
Okay, I have to challenge the logic here. I want you, the listener, to imagine signing a check for $361,000 every single morning, knowing the last 2 times you did it, you basically got a face full of mud.
It's a tough pill to swallow.
From the outside, this just looks like burning cash. Why wouldn't a CEO look at those 2 massive failures, stop the ship, and just redirect those millions to drill more of those highly efficient, cheap wells back in Texas that we know are guaranteed to produce?
This raises an important question, and it's a totally rational one. It really strikes at the fundamental philosophy of risk in the energy sector.
Because it seems insane.
It requires an iron stomach, for sure. But to understand why they don't just retreat to Texas, we have to look at the physical mechanism of how shale rock behaves versus how an offshore conventional well behaves.
Because they don't produce oil the same way.
Not at all. Onshore shale rock is incredibly tight and dense. To get the oil out, you have to artificially fracture it, fracking.
Right.
Initially, the pressure is immense, so a new shale well gushes oil. But because the rock is so tight, that pressure drops rapidly. Shale suffers from something called the Red Queen effect.
The Red Queen effect.
Yeah.
Like Alice in Wonderland.
Exactly. In Lewis Carroll's Through the Looking Glass, the Red Queen tells Alice it takes all the running you can do just to stay in the same place.
Oh, wow.
A shale well produces a huge amount of oil in its first year, and then production drops off a cliff.
So to maintain that 174,000 barrels a day of overall production, Murphy has to constantly drill more and more shale wells.
Over and over.
If you stop drilling in the Eagle Ford, your cash engine dies incredibly fast. You are basically trapped on a treadmill.
That is exactly it. But an offshore discovery behaves entirely differently. Deepwater conventional wells tap into massive, naturally porous underground reservoirs under immense natural pressure.
So it's not trapped in tight rock.
Right. Once you poke a hole in that reservoir, the oil just wants to flow. A single massive deepwater well can produce at a high, steady rate without that steep drop-off for years, sometimes even decades.
Finding an offshore reservoir gets you off the treadmill.
It changes the entire math of the company. The failure rate is high. Civet and Caracol were expensive, painful misses.
Very painful.
But if they strike commercial oil at Babel 1X, a single discovery of 340 to 850 million barrels could single-handedly sustain the company's growth, replace years of depleting shale reserves, and fund their dividend program well into the 2030s.
A massive upside.
Yeah, the math justifies the risk, provided your balance sheet is strong enough to absorb the dry holes.
Which is exactly why they need the Eagle Ford cash engine pumping in the background. It pays that $361,000 a day rig rate without flinching.
Yep.
It is a perfectly balanced, deeply stressful ecosystem.
It's a study in using one type of physical asset to support a completely different type of asset.
So what does this all mean for us? When we look at this Q1 2026 presentation as a whole, it really isn't just a list of financial metrics to appease Wall Street.
No, it's way more than that.
It is a masterclass in capital allocation. They are using the hyper-efficient manufacturing-style Eagle Ford Shale to generate cash today. They're taking that cash and using it to fund those long-term floating skyscraper offshore bets in Vietnam and the Gulf of America that will pay off for decades.
Right.
And crucially, they are carefully leaving just enough room in the budget to take high-risk, high-reward wildcat swings in West Africa.
It is the barbell strategy executed at a multi-billion-dollar global scale.
It really is. But I want to leave you with a final thought to mull over something that builds on all this data we've discussed today. Murphy highlighted in this presentation that they have 50 years of onshore inventory mapped out.
Yeah, 50 years.
50 years of safe, reliable drilling spots in North America. It's pitched as their ultimate safety net. But let's look at the wider macro environment.
You mean the shifting global energy landscape?
Right. If the global economy transitions away from fossil fuels faster than the market currently anticipates over the next 2 or 3 decades, does that massive 50-year onshore safety net actually become a liability?
Oh, that's an interesting angle.
Do those thousands of undrilled shale locations become stranded assets? Like oil that is too expensive or perhaps politically unviable to pull out of the ground in the year 2045?
That is literally the existential question hovering over the entire industry right now.
And if that's true, if the 50-year safety net is an illusion, does that make their quick-hit, high-return offshore projects in Vietnam and the Gulf the true survival strategy for the company's future?
Because of the economics.
Exactly. The projects that have a break-even under $40 a barrel, the ones that can produce vast amounts of oil efficiently before the window potentially closes.
It completely reframes the entire earnings presentation.
Mhm.
The risky offshore ventures might actually be the most conservative, protective bet they are making against a rapidly changing world.
It goes right back to the beginning of our deep dive. It's not just about shoveling coal to keep the train moving today. It's about looking ahead and making sure you aren't building 50 years of track to a destination that no one is traveling to anymore.
Well said.
The true survival strategy requires building the right kind of tracks for the future.
A phenomenal way to synthesize the data.
Thank you so much for joining us for this deep dive into the sources. We love taking these complex corporate mechanics, breaking down the jargon, and bringing the real strategies out into the light. Keep questioning the information around you, and we'll catch you on the next deep dive.